Today's Tuesday, August the 4th, and the McClellan oscillator ticked a little bit above zero, but it's still doing that, moving over and above the neutral zero line. So let's see what it does tomorrow. The stacked volume is exactly the same as yesterday, and you can see that the stocks advancing and declining were roughly the same for both days in a row. Let's take a look at the charts, but this time let's look at three different charts and compare them. Here's the S&P, here's the Dow Jones, and here's the NASDAQ. The first thing you see about the NASDAQ is that it is making new highs. And it is, if you take a look at the February 21st, so here's the COVID drop, it's now approaching 138.2% Fibonacci. But there's something interesting here. We've got two different Fibonacci's that we're looking at. We're looking at the COVID one, which is this one right here. So the COVID high, the COVID low, and that's these blue Fibonacci's. And you can see that we're approaching 138.2. Let's open that up a little bit. So we're approaching actually 150% of the COVID line. But if you look at this Fibonacci, which is this big wave up here, are technical traders looking at that line? Because if they are, it's approaching 138.2. So here you have a coincidence of two different Fibonacci's, two different time frames, one wave up, one wave down, one wave that was a bullish wave and the other wave that was in response to a national emergency. And yet they still both have coinciding Fibonacci's at 11,200, let's say. So that's where the NASDAQ should be heading before it hits technical resistance. So now let's take a look at the S&P. The S&P, let's blow that up a little bit, is looking at trying to complete this gap, which goes back to COVID, strangely enough. So we started with a couple of down days of COVID, and then we really dropped below the 50. And that's the zone that we're trying to recover through. So there's a possibility that at the top of this gap, which is very close to a double top, the previous high of the S&P, that the bears will be sitting and ready to take profits. So the distance that we're looking at in the S&P 500 going up and the NASDAQ going up until it reaches an area of resistance is really not that much different. So lastly, let's look at the Dow Jones. And the Dow Jones did fill this June gap. So we had the COVID Fibonacci here. We had the rebound up to 78.6 and then a pretty sharp rejection. Then we had this drop down on June the 11th, and that's the gap that we've been trying to fill since July the 14th. We actually did fill it, and then we came back to the bottom of the gap, and now we're moving back to the top of the gap. But look what's right up ahead, 78.6%. So all three charts are showing us that there is significant resistance not that far ahead in the future. Let's look at Apple. Apple was up a little bit today, making a new closing high, not a new daily high, but a new closing high. Still a very strong stock. Remember Friday, they go ex-dividend for 82 cents, and someday next week they're going to split 4 for 1. Caterpillar, really, there's a significant trend line resistance, which was last week. And so this week it's not doing all that great. Home Depot is struggling at this series of consistent highs. So it hit this high on June 23rd and has come back every day since then to touch that high, and there have been sellers there every day. Let's take a look at the volume. The volume since hitting this high has been less than the 20-day moving average, except for this day right in here, which was this hanging man type of candle. And the last 2 days have been insignificant volume. So really for Home Depot to break out higher, it's going to need a heck of a lot more volume, and that may come with the new resistances in those three markets that I just showed you. AT&T, which today I bought more of, and I got out of my December 135 short calls because they'd made about 75 to 80% of their premium. Their delta was now so small there was no point in holding on to it anymore. So I took the profits there, and I'm just now running with shares of AT&T, but I did add more shares today, and on any weakness down to 28.40, I will continue to add, because right now we're at a 7% dividend, and if we do go lower, that dividend is just going to get higher. The banks are telling a different story than the rest of the markets. Let's look at the daily, this is the weekly chart for all the big banks. And there's really nothing good here. They are not making new highs like the NASDAQ. They're not approaching their previous highs like the S&P and the Dow. So the banks are really lagging in the market. And in a strong economy where you're looking for investment in the economy, that investment has to come from banks lending money, and they're just not doing it. So the banks might be a little bit more of a harbinger for looking for safety. So I am continuing to accumulate cash. I expect by Friday morning my Apple shares and short calls will be taken away from me, and I won't get the dividend because that's okay, but I will make 60 days of premium. My premium is on September the 20th, so they take it away from me this Friday. It means I don't have to wait till September 20th to get all of my premium. It's roughly the same as the dividend. So I'm happy with that. I will not reinvest in Apple or anything until I find out what happens with this little run up in these three markets. One more time, let's look at these three charts. And these are the areas that we're looking at resistance for. Either the top of the gap here, which is not far for the S&P, or 3386, which is an increase of 80 points. In the Dow Jones, similarly, we're looking at the top of the gap, or the 78.6, which is just above the gap, and the NASDAQ is getting support at the top of the gap, but it's 138.2%, coinciding with a 150%, are just within striking distance. All three charts are telling us that they are nearing exhaustion.